Jay here from Mattress Money Investing, and today we're doing our due diligence on cash value life insurance. And so we have a new format today. I'll actually be doing a live interview, and I'm honored to introduce Steve Parisi of IBC Global.
How goes it, my friend?
Here.
Thank you so much for having me.
Yeah, glad to have you here. This is awesome. And so, as I understand it, IBC Global is sort of a purveyor of cash value life insurance focused on the high end, trying to maximize that cash value. You want to give us a bit more of an intro on that?
Yeah, absolutely. So IBC Global, that is my company. I started it in March of 2015. We focused primarily on whole life insurance, set up for high cash value, because that was my background. When I worked I was an executive benefits planning firm. My role, I sat in a back office. I got to model life insurance policies and set them up to have as much cash value as possible for corporations. And what corporations do, what they did that we worked with, a lot of them still do this, they would take policies out on their executives. The cash value would be owned by the company, so they own the policy, but the cash value is an asset in the balance sheet. They could use it for whatever they want, and then that also provided a long-term benefit for the employees. It's a long version of the story, but what I did, like what our company does, is more or less just teach everyone how to use whole life insurance, just like corporations and the big money have used it forever.
Okay.
Yeah.
And I was by the way, there is a book available. So Steve is not just a YouTube sensation, but also a published author. So I was reading in the book about the corporate life insurance, and I think what you were mentioning was that it was very important to them that they wanted the cash value on the books, and so it was really just they needed, if they were going to buy this life insurance, to have that cash value, or else it would be a non-starter, right?
Correct. Yeah. So it is I don't want to say a pure cash value play, but that's a big benefit. So I can give you a quick overview of typically how they approach it.
Sure.
And such. Yeah. That's why I'm out in the West Coast too. Like why I went to Oregon to meet with someone looking at a company looking at policies for their executives. So typically a corporation, when they look to take out whole life insurance policies, people ask like, why is a business doing that? Like why would they buy life insurance? So one, they typically get it on the owners and their key employees, typically executives, high-level managers. That's usually what you see. People that are valuable and difficult to replace.
So is that, I've heard, I think, the term key person insurance.
Yeah, key person, key man, same thing. So you do get that immediately because now you have a life insurance benefit on those individuals. So if anything happens, that death benefit is paid out. The life insurance death benefit is always paid out. 100% income tax free. So the corporation will take out a policy. Let's pretend you're an executive. They take a policy out on you. They own the policy. They fund the policy. They are also the beneficiary. So if you die, they get the benefit. That might make you feel like, what's going on here? Like, you're going to kill me? And what's in it for me? Like, what is the benefit for you? So what the corporation would then say to you is, Jay, if you stay with the company for the vesting period that they set up front, could be 10 years, could be till a certain age, could be performance-based, all companies do it differently. But if you stay with us for the vesting period, we are going to give you a deferred compensation package, which could be a lump sum payout. Maybe the numbers always vary. Here's 250 grand at a certain age, or it's a payout of 50 grand per year for 10 years, or sometimes they're much larger than that. A lot of law firms will do this with partner buyouts. When they have a partner retiring that owns equity in the company, they'll buy them out, and some of them will use life insurance. So what corporations do for the executive is say, I'm going to give you this deferred compensation package. The benefit to the life insurance product is that we've built cash value up. And that's how they're compensating this now retired executive. So now you don't have to use cash flow or revenue to do so. So what that does is it retains top talent and then rewards them on the back end. And typically how we always set those plans up is when that employee or executive eventually leaves the company, you don't drain the policy and close it out. So if you were promised $250,000, here's a benefit. You get that, we pull it from the cash value, compensate you. but there's still cash value left in that policy, and there's still usually a big death benefit. So what that allows for is when the retired executive eventually passes, now that life insurance policy is still there, and that comes back to the beneficiary income tax-free. So that helps recover the costs that they laid out, and some often will account for inflation a little bit more if possible. But it's really interesting how corporations do that. Like that's the relationship between employer and employee. And then to circle back to your point about the cash value, the whole name of the game is if they're going to put $1 there, they do not want to take a big loss on the balance sheet. That money needs to be there immediately, and they also want to see a positive return on it. So that's what I did when I worked for the executive benefits firm. That's what I do now when we work with corporations. That's what I and my company do now when we work with individuals, is just set the policies up for as much cash value as possible, whether it's an asset in your business balance sheet, personal balance sheet, whatever it might be, and then teach people how to use the cash value, because that's the fun part.
Well, so yeah, a question on that one quickly. Do the companies ever use the cash value if they need some liquidity, the larger ones?
Yeah, really good question. So yes. There's two approaches. One, they can borrow directly against the policy, just like anyone can. And when you take a loan against your policy, you continue to earn compound interest on the entire cash value, which I'm sure your viewers know about. But companies or corporations can do the exact same thing when they're borrowing against these policies, even though the life insurance is in the lives of their employees. Because the policy owner is the corporation, they control everything.
Got it.
So that's one way. And then sometimes what you'll see, like if you've got a big corporation that has 100 plus policies on it, it's a large corporation, 100 employees. In order to get loans from each policy, you need to individually take loans. That's a bit of a hassle. They might not want to do that. So a popular strategy on the corporate level is you can take all of those policies, take the collective cash value balance, assign it as collateral to a bank or a lender.
Okay.
Now you get a line of credit against that cash value, works exactly the same. The interest rate might be a little bit different, but the overall purpose is my cash value keeps on compounding while I'm leveraging it at the same time.
Okay.
Yeah, if that makes sense. Yeah.
To me, it does.
All right.
I'm trying on my channel to help the viewers understand that as well.
Got it.
This is, in my view, another variant on sort of the buy, borrow, die strategy, if you've heard of that. And, in this case, you've got an asset that is guaranteed to increase in value and has, almost no volatility.
Yeah.
So, it falls into a really nice place in, our diversified asset space.
Yeah.
So to your book now, I think it's interesting that you took what you learned from businesses and banks and sort of transferred that and to the individuals.
Yeah.
And, you mentioned, I thought it was an interesting quote starting out the book. I read more than page 17, but you mentioned that, someone of modest means might even just start with $100 a month. So tell me how maybe that person might build a nest egg.
Yeah, good question. So a lot of times when people start a life insurance policy, what comes to mind is, all right, it's an insurance policy. I pay a premium, same amount every month, every year, and it's boring. No one really likes that. So you can set up a policy where you can really put all of your focus on the cash value and have your money go toward the cash value, and you can use it whenever you want. It accelerates the growth, it makes it work. So someone with $100 per month, like how that conversation might go is, they may state, hey, I like this. I like the idea that the cash value is a safe place I can grow money. I can access it. It's also tax-free if we follow IRS rules. But I might only be able to start with $100 per month right now. Can I add more later? So typically what we'll do for an individual like that is start it with $100 per month. That's $1,200 per year for the minimum. And then we'll design it in a fashion where if they want, they can add more money to the policy as the years pass. And if you add more, that goes into what's called that paid up additions or PUA rider, which I like to refer to as a cash dump in, because when you make a PUA payment, you see the majority of it show up in cash value. You can access that begins compound. So someone starting at $100 per month, that'll pretty much just cover their minimum, call it their minimum commitment. But then as time passes and their income increases, they'll be able to add more money, therefore building the cash value faster. Does that make sense?
Yeah.
Cool.
Yeah, that's pretty cool.
Nice.
One of the analogies I like to use, and nothing is a perfect analogy, but is to look at it maybe like a mortgage,
Yeah.
and the cash value is sort of your equity in the asset, right? And PUAs, paid up additions, are sort of a way if for some folks they like to overpay on their mortgage so that they own their house faster.
Yeah.
In the case of the life insurance policy, contributing to those PUAs gets you more equity into your policy, right? Your death benefit is the sort of the market value maybe or target, and you're owning more of the policy sooner, which means more equity and less interest. So right on the house, people are trying to pay less interest total.
Yeah.
They want the ownership, and here you're paying sort of less insurance. You could think of that as the interest, and building your equity in the policy. Your equity grows because of the dividends, right? And the guaranteed, as well as the supplemental dividends.
You got it. Yeah, you got it. And on the cash value too, like the thing I always like to explain to people is whereas your equity grows, they say, okay, like what's that cash value? Sometimes people say, what's that? Like it's money that's yours. You can access anytime you want. If you wanted to actually access that cash value and see it go to your bank account, you can request it via a loan through your mobile app, online account, very, very simple. Typically in 3 days or so, hit your bank account, direct deposit, sometimes quicker. But it's very easy to access that cash value too, which is nice. Yeah.
It's something I have to explain to a lot of my friends. They're like, insurance, well, what else is there? And I'm like, the interesting thing is it comes with a line of credit. And they're like, this is so interesting. Yeah. I never knew. And then I'm like, and then the appealing thing is, in many environments, it would be a competitive or more competitive, lower interest rate. And then in an environment where maybe the interest rate is higher, coming from your line of credit with your policy loan, so to speak, you have two choices. One, you could go maybe, like you mentioned, use a bank instead of your policy loan. Or two, you could say, well, I'm probably getting credited more inside my account if the external interest, if the policy loan interest rate is higher. So you could sort of go either way depending on your preferences.
Yeah, and the interest rate environment, some people don't like to do anything with banks. Some will use those line of credit loans if the interest rate is more favorable. But it's optional, and it's very easy to switch back and forth. Like we've never run into any issues with our clients doing that.
Okay.
Yeah.
You mentioned a lot in the book about sort of the philosophy of either agents may not be aware of how to do this, or maybe they're just not incentivized to do this.
Yeah.
Do you foresee this ever really changing? I mean, I know you're advocating and you're educating, but do we think there will ever be this tidal wave? Because I would share that I feel like if it became the default, the high cash value, the sort of front load, I would worry personally about there being some IRS scrutiny, unfortunately.
Yeah,
right?
I'm with you. So a couple things on that. Well, one, like, do I think it will happen, like a tidal wave of more and more people getting cash value life insurance with it rich up front, like truly designed for cash value? I don't, simply because the industry incentivizes and trains all agents to do the opposite. So everyone who gets in the door, including myself, you are trained heavy on that. I recall times where I would bring up to my manager, like, hey, well, why don't we design it this way? Like once I learned the software, like you have more cash value. And I would just shut down very quickly. No, you can't do that, right? Like don't even question me on that kind of stuff. That happens so much across the board. So you are up against that as a new agent, and that is the norm. When you look at the industry statistics, the last time I checked, was a little bit more than 90% of whole life insurance products that are sold in not an attractive manner, where it's typically zero or very low cash value up front. So I don't think that a tidal wave will come. It'd be nice. But if it did, I think that it will take quite some time because A, the industry does incentivize agents to do the opposite. And then B, the product is complex to most people, and just human nature, when something is complex, it's either, forget it, I don't want to look into it, or I trust someone. And when I trust someone, they're either going to truly do the right thing because they know what to do or not. Like a lot of people
Right.
just, fall into traps there. So do I think that it will happen? This is just my gut feeling. No. That's also based on my experience. And then the IRS piece that you mentioned. I used to think that all the time, that if this does become very, very popular, that the IRS will come and say, hey, we're going to change this now. So my attorney, who's also become a good friend of mine,
As mentioned in the book, yes.
she is the best, even though that first meeting, she was coming to, I say, chop my head off. But no, I appreciate the way that she's always respectful. She's well connected, and she was sharing a story with me several years ago where she had met with someone where this individual was lobbying at Congress, or I forget exactly the setting, but it's like, this is it. Like, we are going to get the laws changed around cash value life insurance. He was convinced everything wasn't like was put in place, and just very, very quietly like, no, what are you talking about? That's not going to be done. Too many people there own it, the product that is. So you have that. I remember when Trump ran for office in 2016, I was scared initially because I saw in his proposal that he proposed changing the laws around cash value life insurance and taxing it. So naturally, being that this is a huge driver of my business, I'm like, what's going on with this, right? I stay neutral in politics. I don't get involved. But that did get my attention. With that said, the new tax proposal, when it came out, that was just removed. Like no conversation, nothing
disappeared.
around it. Yeah, just disappear.
Smoke and mirrors.
I know, right? So I've seen that kind of stuff and heard, like Elizabeth, where she knows a lot of people just in high places everywhere. Like getting that from her, I'm like, okay, like I've always heard that, hey, if this gets popular, the IRS will tax it. When I see factual data on it, I'm like, no, I don't think that it will. That's my feel. Yeah.
It's used by too many sophisticated people to let it go.
Correct.
I could see that. I'll agree. Like, I feel like when I'm talking to friends about the product and explaining, right, does it make sense for them? I generally look at two main points. One is your tax bracket
Yes.
maybe, such and such so that it makes sense, from a numbers perspective?
Mm-hmm.
Are you a patient person? And then at some level, I'm like, if you're not going to do buy, borrow, die, or there's not some legacy play, it may not be a thing for you. Because if they're not going to learn how to use the loan
Yeah.
feature and there's not some sort of generational wealth play, then
Yeah. It can be tough. Yeah. So, I mean, what you just mentioned, the people who are into that, the generational wealth or into leveraging the policy are attracted to it. They will buckle down. They'll read that book in a day. They'll watch a million videos. They want to understand it inside and out, and they want to know what company and product to select. Others that we see attracted to the product, we do see high net worth folks that often will view it almost as an alternative to a municipal bond.
Mm-hmm. Yep.
So, for example, there's folks that I'll connect with that have millions, sometimes tens of millions of dollars, whether it's in money market accounts, treasuries, whatever it might be, and they have it there because it's safe. That's why. They don't have to worry about any fluctuation, and it's also liquid for opportunities. So, to give you an example, about a little bit more than a year ago, met an individual. He is very, very bright. He works, he's an officer at a hedge fund. He's worked for Goldman, JP Morgan, one of the sharpest guys I've ever met. He's been interviewed on channels similar to MSNBC. So knows his stuff when it comes to finance, tax, everything. He had about $5 million in a money market for opportunities. He lives in New York. He's in the highest tax rate. So he was earning something like 4.5% in the money market. After tax, though, he's not earning that. He picked this up very, very quickly. Cash value life insurance. We looked at how he could maximize the cash value, especially up front, because that big hit, like he wasn't having it, and I would advise no one to take that either. So just in looking at it, we were able to get the peak annual yield on both of his policies. He did one with MassMutual and one with Guardian, right around 5.5%. That's what it'll peak at. The IRR will be closer to like 4.5 to 5%.
okay. Still sounds like a preferred plus, but
Correct. One of them he got preferred. The other one he got preferred plus.
oh wow.
Yeah, but performs quite nicely in that regard. He started a big lump sum too,
Wow.
so that helped him. But he did that because he looked at the yield and said, all right, even if it's 4.5%, which is the same that I'm getting in the money market, here I don't have to deal with any taxes. It's tax-free as long as I do everything right. I got the upfront hit, right? That's the hard part. So it takes about, for him, 4 years just to break even. So we've got to overcome that. But after that, I don't have to think about it. It grows without any market risk. It's tax-free. And if he wants to leverage it for an opportunity, he can borrow against his cash value while he continues to get that 4.5 to 5% year over year, or whatever the growth rate is. So he looked at that and it was a no-brainer. He's like, why? Like, why would I not do this? And then he said, it's a crime that more people don't understand how this works. And that's coming from one of the sharpest guys I've ever met just in the field of finance.
Right.
Yeah.
I'll have to send you, I've got a video and I should probably do another one where I have a little table and I put the high yield savings accounts, I put CDs, a municipal bond fund, a couple other products,
Nice.
and then I put in SGov, so treasuries, and I put cash value life insurance. I just gave it a 4%, but no taxes.
Yeah.
And a couple other things just for comparison. And then what I do is I have a settings area where you can put in your federal and state tax rate. If you have
Nice.
net investment income tax,
So when you
sort
said-
it by the after tax, and then sort it by, you can put in inflation if you want to see.
Yeah.
But once you sort it, you're like, okay, for my tax bracket, for me, right?
Yeah.
Savings accounts after taxes are, below 3, after inflation, negative.
Yeah.
I don't break even until I hit, maybe one savings account could break even with inflation. Municipal bonds, 0.5%, cash value life insurance, 1% after inflation.
Right.
After inflation.
Yeah.
So that's the thing. People are like, is it an investment or not an investment? I have a different sort
Yeah.
of definition for investment. If I'm putting my money into something for it to vest, there's different types. There's the principal protection assets that
Yeah.
I'm investing in, and there's the growth assets. And this one is to protect my money from inflation.
Yes.
Right? Where savings accounts are going to lose money to inflation. And so it's my better principal protection,
Yeah.
Sort of storage vessel for that emergency fund and for that, opportunity fund.
Yeah.
So, it's, that's sort of where I'm trying to place or position
Good move.
cash value life insurance. And, it's like I hit that level where I did my taxes similar to your friend. And I was looking, I think it's line 6, and it's like taxable interest.
Oh, yeah.
And I'm like, that's from my savings account. That's from my emergency fund. And then I filled out another form that was net investment income tax. And I'm like, wait, you're going to add another 3.8% tax
Yeah.
on the interest on my savings account? And then I ran that calculation that I mentioned with, after tax, after inflation. And I'm like, I'm negative.
Yeah.
I lost money. And even if you invest in something like government I-bonds or TIPS, which are inflation protected, you then pay tax on those.
It's tough.
And you can lose to inflation again
Yeah.
because you pay the taxes on those.
Yeah.
Cash value life insurance. I've got another graph. I took the Guardian numbers and compared it to the CPI.
Nice.
And over, 40 plus years, typically tracks inflation plus 1 to 2%.
Okay.
There's a few year delay or lag because they got to buy the new bonds,
Correct.
let the old ones mature. But that's what I tell folks with cash value life insurance. You're going to stay a little bit ahead of inflation. That's your vessel that you use for your emergency fund, your storage,
Nice.
storage tank for opportunities.
Yep.
And then I want to do some more videos on policy loan, and then not how to do policy loan. That's where they watch your videos.
Oh. Yeah.
Mine is about how to take actually what you do with the policy loan on the other side,
Got
like
it.
trying to take them to the deal flow,
Yes.
and then how to do the tax deduction,
Nice.
and then show by doing this. Some people call it the double dip strategy.
Yeah.
It's related to buy, borrow, die, right?
Yeah.
How you can turn maybe a 15% investment into one where it's still a 15% investment, but basically whatever your loan rate is
Yeah.
from the plan is your tax-free
Yeah.
rate of return on
We're
that
tracking-
investment. So
yeah.
basically it converts part of your investment into an untaxed portion of that investment. Basically, if you compare, if I just had the cash, let's say in a savings account,
Yeah.
deployed it in the investment, and then when I'm done, put it back into the savings, versus if I put it into cash value life insurance, take the policy loan, make the investment, and basically at the end of the day, from what I see, you can either say I made 15% and pay taxes on all of it, Or you could say I made 15%, but I'm only paying taxes on 10% of it.
Yeah, that's much better.
That's a huge, huge difference,
better.
right?
Mhm.
And so let that compound over your life. And it's a great learning. It's sad that it took this many years to come to this
Good.
conclusion.
Yeah.
But I don't want to take all your time. I know you've got a busy schedule,
No,
but I
good.
do have
Yeah.
from your book, and I've noticed this on your recent YouTube videos. You've made a pivot. Your book says this book is more technical than I would like. And then, I noticed from watching your videos, essentially, I've noticed that now you seem to be focusing on maybe wealth mindset. Because people, because the TikToks think, oh, if I buy, well, sadly, it's often IUL, but,
Yeah.
well, and there is a place for IUL in people's portfolio,
Yeah.
right? But they just think if I buy it, magic happens and I become wealthy. And no.
Correct.
Once you have this wealth engine,
Yeah.
right, which starts with mindset, right, then I feel like this is sort of like a turbocharger that you bolt onto the engine to make it more efficient,
Yeah.
right?
Mhm.
And so I don't know. What motivated you, and like where are you trying to go with this change?
Yeah, good question. So the cash value life insurance, like I'll always still talk about that because I just have too much fun, and like I have a hard time not doing it, just talking about how it works, what not to do, what to do, user case studies so we can show people how they used it to buy real estate, just maximize the cash value, whatever it might be. Some of the corporate stuff too. But with some of the more recent stuff we've been doing, whether it's around wealth mindset, what to do with your money, talking about other areas to position your funds, or if it's just general advice on how to operate a business, which is just me sharing my experience. So that came from two areas. One is internally, we did discuss branching out a bit without losing our target market. Because the one thing is I do know exactly who our videos target, who likes them, and then how it translates to them reaching out to wanting to work with us. So I did not want to lose that. So the videos where I'll speak about more than just cash value life insurance, I'm speaking about things that are based on similar conversations I've had with our clients that I know reach out to us. So therefore, I feel like it won't push people away or say, this is boring. So just based on customer experience, that's one. And the other thing is we hired a YouTube, call it agency, that primarily focuses on YouTube education. And they're a big driver behind it in terms of what type of content to create to really try to attract our audience. Because we might have someone like the gentleman I mentioned who works for a hedge fund. He didn't find us on YouTube. Eventually, he saw YouTube videos after we connected, but that's not how he found us. So leading with cash value life insurance will not always attract people, not everyone. And I don't want to attract everyone either. Like we've got a very specific, I used to take that approach, but was like, no, there's like a specific market we go after, people who like working with us. They're typically a little bit higher income, a bit higher net worth. We work with a lot of people like where you work at tech companies, engineers, IT professionals, folks that like the details and attention to detail. And I don't want to lose that either because that's always been our core market, who we work really, really well with. But working with that agency to try to branch out and just hook people's interest and attention more as we continue to scale the company, that was a big driver behind that.
Okay.
Yeah.
Yeah. I can see how it would
Yeah.
perhaps bring in some more folks around the edges, and then they can come in and start watching some of the historical videos.
Yeah.
And actually watching the historical videos, when did you pivot from, it felt like the earliest ones might have been more like educating other insurance agents. And there was a pivot to case studies that might have been when you switched to like DIYers and the analytical consumers.
Yeah. Good question. So the goal was never to educate agents. A lot of people have asked me that.
It felt like that though.
I know. Like I even had one client. He does really well. He coaches chiropractors on how to scale their company. And I remember sending him a video. He's like, "You talk to me as if you're trying to train me like I'm an agent." I'm like, I gotta adjust the way I talk, right? Right. So depending on who I'm speaking with, right? Obviously, because he's not super technical, but the early years, like my background, going back to the executive benefit days, was designing policies for corporations. And when I started my business, I was not, and I'm still not, the most talented when it comes to one-on-one conversations and meetings. I was so nervous. So what I would do in the early days, I would connect with them, and it would usually be over a go-to meeting back then. That's what I used. And I can just show you what corporations do. So I just pull up the software, we'd build out a policy based on their specific needs and what they're looking for and their numbers, and we would just walk through it. So naturally, if I'm using the software as the tool to demonstrate it, it's going to be a bit more technical. So that's what I did, thousands of meetings, one after another, one-on-one, and then started YouTube. And it was really just, that's what I knew, and it worked, so we started doing that. So naturally, talking about those technical nuances of how to build policies and the product details, a lot of times people did think that we were doing that for agents, even though we weren't. So did that for a long time, learned more what consumers are interested in, so then tried to make it more simple, use different types of visuals. And just as I've learned more, I try not to be stubborn and just make sure that I'm creating content for people that I know are our avatar, like the type of people that say, hey, this is the kind of stuff I'm interested in. I want to know how I can use this to better my life, my business, tax-free income and retirement, real estate investing, whatever it might be. And I know how they dig into the product. Therefore, I'll create content that's tailored toward that. I do try to stay very, very focused on that.
Okay.
Yeah.
Yeah, I could see, my thought on that is, my wife does something with her business where she sort of floods the channel, is a term I've heard, with different products so that it makes it easier for someone to search for just what they want, right? I think of, now YouTube search doesn't always find the
No.
video that I'm looking for of yours, but if I do, I could say, hey, Edwin, I want it to be like that,
Yeah.
but tweak these things.
Nice.
And it makes it a lot sort of easier and faster because you already have a preview of what's going to
Yeah.
be on the other side. And you're like, let's just nudge these parameters, divide that one by 100.
Yep. If you do that, you probably
Pretty
have gotten
close.
closer than you would expect.
Yeah.
A lot of times that's how it works. As long as the product's designed the same, that's the big thing. Yeah. If I don't try to manipulate it to increase the compensation, then it'll look the same.
Well, I mean, you've already, I love how you pull back the curtain and it's like, here's how the insides work. Here's the commissions. You tell us all the ins and outs of what to look for in the policy. And it really just makes it easy for consumers to, better shop and then understand that when they come to you, it's just going to be, we're just going to get the most efficient, cost-effective product.
Yeah. No, thanks for sharing that. I mean, just make it transparent. That's always been my mindset. And if I'm the consumer, what I hate is when I work with someone and not everything's disclosed. I find out something after the fact that they didn't tell me. And it's not always deliberate. If it was an accident, I don't really care. I'm like, okay, that's fine. I've made mistakes. But when you can find out it was intentional or they did it to try and make more for themselves, I've seen that. Like when I was a young agent working for managers, see how they would sell products, and an engineer that we were sitting on the other side of the table would start asking about the paid up additions rider and just the word games that would go on to try and keep that base premium higher or use a company or product that paid a higher commission. All call it the sales tactics that go in there. I didn't like it just because my thought is, well, if I'm on the other side of that, and then I find out later you didn't show me the best option or you weren't transparent with me or you just answered the question and didn't give me, hey, by the way, think of this too, I'm not going to work with you anymore.
Right.
So it's just be upfront, be honest with people. That's it.
I mean, we don't have to dive into it, but from what I understand, Kyle Busch just ran into this with Pacific Life.
Yeah.
So when that's, and I think they said to the tune of over $10 million.
Yeah.
That's pretty scary.
So that is. And the thing is, I did see that. I've seen cases way worse than that.
Oh, boy.
Oh, yeah. And sometimes with whole life, but based on the design. There was a case earlier this year, young guy, late 20s, putting away $7.6 million per year. Yeah, into a whole life insurance policy. Ridiculous.
Is it all base?
Huh? Yeah, it was all base.
Oh, my
So
goodness.
it wasn't a traditional whole life 100 product. So he didn't have zero cash value in the first year, but he paid $7.6 million the first year, and his first year cash value was a little bit more than $2 million. Think about that.
Oh, yeah.
So what Kyle lost, right, over the duration this kid lost almost in 1 year, call it almost 2 years, right?
Right. That's
but
amazing.
I
Wow.
do like the fact that Kyle made that a bit more public because he's got more out there, which is good. So it'll help bring awareness. But yeah, that kind of stuff happens all the time. And I remember with a young kid, when we saw that, I'm like, what on earth? And my attorney, just when I was talking to him about it, Elizabeth's partner, he was like, people just trust the wrong people a lot of times. Because the kid started asking about it after the fact. Like, the policy was old.
It's a pretty big contract to sign without asking for a second opinion.
I know, right? But referred to a insurance or financial professional from your trusted estate planner. So, hey, they say it. They've always done good by me. The estate planner probably doesn't know insurance inside and out. They just refer someone else. So you have like all these moving pieces, and it's just difficult. So if you're locked down running a business, and like that's what you're focused on, and you've got a ton of cash over here that you know shouldn't just be sitting in cash, that's where cash value life insurance comes up.
Right.
But then as soon as it comes up, it's like, okay, now I either need to do the research or I got to make sure I hire someone that really understands it in and out, whether it's an agent, because I'm trusting them now. Remember, they're incentivized to do the opposite. Or you can hire a third party advisor. There's actuaries. There's one I've worked with over the years I like a lot, where he doesn't earn any commission. He'll review the policy just for an hourly fee and tell you exactly what to do and what not to do.
Wow.
Yeah.
I mean, if it's a big policy, that's not
Do
a
it.
bad idea.
Correct. Yeah, do it because
It's definitely worth it to make sure that you're getting the best
would have
design.
saved that kid millions
Millions.
upon millions. Yeah. Well, I mean that. So yeah, the thing that you mentioned with Kyle, I didn't mean to detract from that. That does happen a lot, and it really just comes down to having awareness up front. The product's important too. Like with Universal Life, I'm a big proof guy. I do like to see proof of performance because the life insurance industry is known for not providing proof of performance and over-promising and under-delivering. I've seen proof with 4 companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual. When they're designed with low premiums, that's where I've seen the highest actual IRRs and cash value, not good-looking numbers on paper. So that's why I like those 4 major mutuals. I haven't seen it with smaller companies. I haven't seen it with Universal Life products, IUL that is. So that's why I always go back to those big 4 because I don't have to worry about something outside of my control going on
Right.
that hurts the client, and then that ultimately will hurt me.
Yeah, the whole thing where Universal Life, they can
Yeah.
tweak things later, change all the cap rates. And, my mom doesn't have Universal Life, but she does have an annuity from one of those same companies.
Okay.
And the cap rates over the years have fallen to,
Yeah.
like, how can you have a cap rate on an S&P 500 that's 1%?
So
Does it?
she's the
I think
honest- yeah.
I think their general fund must have come down, and they're
Yeah.
squeezing.
Two things with that. So she's probably beyond the surrender term. So
I think she can still surrender, but it would not be in her favor because
Okay.
with the annuities, you have the 2 different piles
Yep.
of money.
Yep.
And the income pile is very large, and her surrender value is
got it.
down here because there's been a fee that's been coming out of the surrender
I see.
side.
Yeah, and if you get an income rider, like typically what I advise clients to look at, whether it's an income rider or just a deferred income annuity, is your account value. It's not going to grow that much. It might project to look good, but it's not going to. Like,
Right.
It's going to be slow.
The fixed income annuities are a bit oversold on
Yeah.
the market participation.
Don't.
They need to work on the wording on that one. It should, at a minimum, it should say like partial
Yeah.
market participation
Yes.
or fractional market participation, asterisk. Fractional, we determine year to year based on how we feel.
Yeah.
That would be a scary asterisk that would hopefully get people thinking. But
Yeah. You can always find the info. And the best people I know in business don't do that. They make whatever their area of expertise is transparent to everyone. So I'm all for that.
Well, fantastic. Okay, well, folks, hey, if you're a book person and a math person and you want to learn more, definitely pick up Steve's book, give it a read. This is, very easy read. It's got all the numbers. It's fun. It's only like 170 pages. Like Steve said, you can read it in a day if, that's what you want to do on your weekend. And if the book is not your thing, check out his channel. 1,800 something videos. It's not, and those aren't shorts. These are on average 15, 20-minute videos. So if you're interested in the topic, do a search on his, page, and you'll be dazzled with all sorts of case studies and learnings. So thank you, Steve, so much. I appreciate it. And, thanks for coming to Seattle and seeing us.
Thanks so much for making time. This was fantastic. I'm glad I could finally meet you in person.
Likewise. All right. Take
Thank
care.
you.